Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Peter Moss. Peter is a mortgage agent at WIMAC Capital, Inc., where he has worked for the last 13 years. He originates loans for his own individual clients and for the clients of CPAs and other financial advisors in a unique and well thought out partnership. WIMAC has 5 issued patents covering this teamwork that's compliant with all regulations and provides a superior client refinancing experience. In Peter's past life, he's had a lot of varied experience, starting with a public accounting career at Ernst & Young in Chicago, and then he worked at Charles Schwab, and he was involved in developing many innovative systems there, including online trading for advisors and later for clients. So he has a really strong tech background. Anyway, today Peter and I are going to be talking about big picture strategies for the home mortgage marketplace. And by the way, this interview is taking place on June 26, 2012. So you're going to be watching this sometime later. And this market does move, so be aware of that. Again, that's why we're going to try to focus mostly on the big picture. Also, I want to make clear to our viewers that we're not talking here as investment advisors. The mortgage advice that's provided is coming from Peter, in this case individually, and isn't necessarily a position of his brokerage firm, which is WIMAC Capital, Inc. So before getting started, Peter, why don't you talk a little bit about this concept of getting the big picture, and how it is involved in this whole mortgage scene that we're seeing these days.
Well, what Mike, most people don't realize is that over the years we have been coming down in stair steps in rate, and every other external financial consideration is really secondary to that. It's similar to the old adage, location, 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 buying real estate. If one buys an expensive house in a dangerous neighborhood, they've probably made a mistake. Mm-hmm. And that also applies here. Since 1989, it's made more sense to do a no point, no fee refinance, which have been generally available since then in most instances, except for a few months here and there. Mm-hmm. Similarly, someone buying 30-year treasuries or the equivalent each year for the last 30 years has generally outperformed equities for the same reason, in that we've been in a declining inflation environment. Mm-hmm. Some might call it deflation, but basically it's mild inflation that keeps on going down and down and down in what I call small circles. But it's fascinating. It's taken nearly 30 years since we had the spike in interest rates in 1981, and if we could see the first chart, that somewhat illustrates that.
Okay, so please put up the first slide, and so you
we'll
can go ahead and talk about it.
Well, what that slide illustrates is that we have a big spike coming out of the 1950s in interest rates after a run up into the 1970s, which led to a recession, as you can see. The darker areas, the grayed out areas, are periods of recession, at least the formal declaration of recession. And then we had the big Volcker pop of the bubble in 1981. Mm-hmm. And as you can see from this chart, we've basically been in a fairly steady decline with the usual jagged movements since then. Mm-hmm. So someone who took advantage of those declines when they came and did a no point, no fee refinance generally was way ahead of the game and avoided not having a break even on their loan costs. Mm-hmm. Previously, the implications of that for buyers of mortgage paper is that sometimes they would lose it, it would be refinanced, and it would go away as they, as an investor, would be holding this. But because of the law of large numbers, these holders have done well as well, because they have held paper that had higher than current interest rates, and those rates just keep on going down. Mm-hmm. So recapping what's happened in the mortgage marketplace in the last several years, we had the meltdown in 2008, in those days everybody had to qualify on taxable income. Underwriting has become much stricter since then, and even second mortgages have been tightened up. So right now, second mortgages stop at 80%, where most first mortgages also stop. Some stop at 75%, for example, for a rental home.
So what that means is if somebody's going to finance a $100,000 home, that the most that they can expect in most cases to be able to use for financing to raise is $80,000 of the $100,000.
Right.
Between the first and the second mortgage, and then what the mix is like, it relates to some of the dollar limits that we'll be talking about later.
And of course, in Stockton, you might be able to get a $100,000 home.
Yeah.
In the Bay Area, that's not going to happen.
Right.
What we have seen, though, is the economy has pretty much dictated what's been going on in the first part of an inflationary era, deflationary, as you saw in the chart. It tends to benefit everybody. People who are refinancing as well as people who have equities. But we're in the latter stage of that deflationary period now. When it'll end, I don't know. But because of that, we're seeing the economy hit much harder. And you're seeing that now pretty much across the board. It's become visible first with the bubble popping in real estate, but also now with the general economy slowing down, with more bubbles popping, such as in Spain. So since consumers are approximately 80% of our, or 70% to 75% of our economy, they've become heavy savers now. And ironically, what they're achieving in savings is a fairly low rate compared to what they were able to make 5-10 years ago. And yet they're satisfied with it because they like the safety of those savings vehicles. That has obviously funded, on the other side, mortgage refinancing, because a lot of those monies can flow through to people who are borrowing for homes. So right now, the average well-qualifying household taking advantage of these rates is likely to be able to stair-step their mortgage rates down as long as their credit and equity is good. They do have to have self-employment or a job that's commensurate in income with what they're doing, and that hasn't really changed in the last 15 years, except for the brief period where we had the old stated income loans.
Right.
So the mortgage marketplace has not changed for the well-qualifying borrower. It has changed for a lot of other people.
Okay. So let's talk a little bit then in general about how the whole mortgage lending picture has changed. So, you know, going from, say, about 2005 to where we are now.
In those days, and we certainly did some stated income loans for the clients who had good credit scores, which were required in those days for the stated income loans. We were doing a lot of those, and it made sense for clients, and they could lock in great rates and close them with no points and no fees. Right now, those clients are basically stuck in what they had from those days. Fortunately, a lot of them got very good rates. Some of them took adjustable rate mortgages, which were popular in the middle of the last decade. And those, in many cases, have adjusted, and based upon the adjustment to a very low base, they're enjoying much lower rates than they started with.
Yeah, the treasury rates that are close to zero.
Short-term rates on the 3-month treasury have been bordering on zero.
Yeah.
So that's a wonderful thing, because the indexes are generally based on 1-year indexes of various kinds.
Yeah. So, so we had these stated interest loans, but now things have changed where I guess there's a lot more, and I guess I know because you and I work on these together, there's a lot more documentation that's required now to be on board to substantiate those loans.
And it does take longer on average.
Yeah.
The major bricks and mortar banks are taking 90 days right now if you're lucky. Mortgage brokers can lock for 45 to 60 days depending on the lender they choose. Part of the problem here is a lot of lenders as well as loan agents have left the business because of tighter regulation, tougher tests, and quite frankly, the economic period was very difficult in the last decade on those people, those professionals. And so the population eligible to refinance you is shrunk greatly. And people like Wells Fargo are now up to 30% market share, which in many areas would be considered a oligopoly or even a monopoly.
Yeah, kind of crazy.
But the Justice Department doesn't seem to be minding that to help us get through this era.
Yeah. Okay. Um, okay. Well, let's see what. Why don't you talk a little bit about reverse mortgages for a moment? And,
Well, let
because-
me do mention one thing that is a trend before we move to reverse mortgages, is that
Alright.
is the shorter term maturities have become more attractive.
Oh, like the 15-year mortgage instead of a 30-year.
Exactly. A lot of our clients who start out with 30-year mortgages and then may have moved to 20-year mortgages, then moved to 15, and now many of them have 10-year fixed mortgages.
Wow.
And the spread between those has widened a little bit, so that there's a bigger advantage for the 10-year than there used to be.
Uh-huh.
And part of that is it's less risky for the investors.
Sure.
It has the lowest default rate, which the 15-year has the next lowest, the 20-year has the next lowest, and the 30-year fixed has the worst default rate.
Mm-hmm.
And so because of that, the rates are attractive, and of course that allows clients who are getting up in years, which all of us tend to as a course of life, see their mortgage shrink, and they shrink the amortization period at the same time, which is a wonderful thing.
Well, and if you think about it, it makes sense. If you've had a mortgage already for 15 years, okay, then it shouldn't radically change your payment that much when you've got a reduced interest rate and you're taking the remaining term of what you would otherwise had on your mortgage.
And we encourage people who do a refinance to stay with their old payment, particularly if they're staying with a 20-year fixed or a 15-year fixed. Stick with your old payment and amortize the loan that much quicker, because all the extra dollars pay down principal,
Yeah,
and therefore the life of the loan shrinks.
yeah. It's hard for people to do that, though. They get that monthly bill and they see, okay, this is what it says I'm supposed to pay, and so they go ahead and they pay it. And it would be nice if they had the discipline, you know.
We encourage the discipline of auto
Yeah.
payments. That way
Sure.
there's no thinking about the higher payment.
Yeah.
It's just the bank makes it automatically.
Uh-huh.
And it's a great thing.
Okay.
Getting back to your question on
Okay,
reverse mortgages.
Because it used to be that you and I would discourage people from thinking about even doing a reverse mortgage, that we would look at equity lines instead.
Those were very popular, and they were a much better deal. In those days, we would analyze loans, and maybe 1 out of 100 would make sense for a 95-year-old or someone very advanced in age. And even then, there were complications. Right now, equity lines qualify as first mortgages do on income. So unless someone has fairly substantial income, then it's not going to make much sense, because the loan they're going to get is very small based upon their income. But on the other side of it, these people have relatives. They have kids,
Mhm.
they have siblings who may be younger or in a stronger position, where they can go on the loan. And what we do is called a blended interest loan. The rate's just barely higher, and yet they can qualify if the person, such as a son or daughter, goes on loan and doesn't already have a second home. So it works. It's a great thing. We do encourage the sibling or child to get a copy of the mortgage statement,
Mhm.
because then they can see what's going on, and if the parent's getting on in years or the sibling's getting on in years, they can always catch a late payment before there's damage. And that's a great alternative to a reverse mortgage. You may see ads by people like Robert Wagner for reverse mortgages, which is indicative. They are basically a promotional type item. They are federally insured by FHA, but the economics are very, very poor. There is mortgage insurance involved, and of course, if someone has to move into assisted living, a nursing home, the loan can be called, and often is.
Mhm.
And so they can lose their home.
Yeah. So the issue is, we've liked the equity lines because they've had very low interest rates, for one thing. It provides some flexibility. I mean, really, what we were able to do was to borrow against the equity line to make the payments on the line.
Right.
And so it would function more or less like the reverse mortgage in a sense. The reverse mortgage is an arrangement where, in essence, you don't have to make payments. And so people like that, basically they're trying to annuitize the equity in their home. The problem with them is that they have very high costs as far as the commissions and so forth, and the interest rates are higher than
That's
on
correct.
a standard
That's
mortgage.
correct. As I said, they pencil out rarely, even these days. and the amount of money you can obtain is relatively small. Most people are very surprised by how little they can get on a reverse mortgage. You hear ads, but most of them aren't really correct in terms of what you actually can take out. The other thing that a lot of people did, even if they weren't of retirement age, is they took out a large second and did what banks have done forever, and that is borrowed short and invested long. So they would put that money into, for example, long-term treasuries and effectively have an arbitrage going. And those who were wise in doing that sort of layered out the maturities so that they would come due over time. And of course, the interest was actually higher. It may have not started out higher, but certainly became higher than the rate on the variable rate loan, which was below prime, which is now, a lot of people have 2.25% money who did that. It's a wonderful thing.
Yeah. So if you were able to work out that sort of thing, and you had to be pretty disciplined and savvy in how you put together that sort of an arrangement. But for some people, it did make sense because they were able basically to make more on what they were investing than the interest that they had to pay.
Historically, a lot of clients focused on their investments and really neglected their mortgages because they figured it is what it is. Over time, those is what it is situations have changed as the rates came down and people could take advantage of what we call a one-way mortgage or a one-way bond. And that is, if in fact they have a good rate and they can get a better rate and they don't have to pay for it, it's basically a one-way bond trade. They're trading in their old loan for a better loan, and they can do it with no cost. Now that has even changed. Last April, the Federal Reserve changed Reg Z. And now you can refinance, and if you're with a mortgage broker, unlike a bank, with a mortgage broker you can actually be paid to do your mortgage. Used to be we as mortgage agents and brokers would keep whatever was left over. We weren't legally allowed to give the clients any excess from a no fee loan. Now that excess, with the Reg Z change last April, a year ago April, has to go to the client. So I did a spreadsheet for our first quarter production, and a large number of clients made $1,000, $2,000, or even more on every refinance they did. And we had clients refinancing every 6 to 8 months, which is not unusual. That's the normal interval for a well-qualifying client if rates continue to go down, as they often have been over the last 5 years.
Okay, let's get into a little more details as far as the conditions for loans. So we're talking about now what are the amounts and where are the best rates available. So why don't we give a little information for that.
We've been at pretty much the same level, $417,000, where the very best rates are just under that amount. If you go over it, if you're $417,001 for a new mortgage, you're 3/8% higher rate. So there's a big cliff to go off of once people have these small, what they call jumbo conforming loans. So a lot of people at that point switch to a $417,000 loan and can do either prior or concurrently, which they call a piggyback loan, a second line of credit to take up the difference if they don't want to pay down to $417,000. It's a good alternative. On the other side of it, as someone gets a smaller and smaller loan, the economics are such that less premium is generated, just the way it works the same way as a bond, and therefore their rates are going to be higher if they've got a $197,000 loan than if they had a $250,000 loan or $350,000 or a $417,000 loan. So basically, in those numbers I just mentioned to you, you can see a stair step of an 1/8% down. It doesn't always work out that way. It's a good approximation.
So for some people that might seem counterintuitive. They think, well, the bank has less risk because they're making me a $100,000 loan instead of a $400,000 loan. Shouldn't I be paying a lower interest rate? But it doesn't work that way. It more has to do with an economy of scale, I guess, is the way to look at it.
Transactional cost, that's correct.
Yeah.
The cost of doing a $255,000 mortgage for us are virtually identical to a $417,000 mortgage, and yet we're almost making double gross premium to pay for our costs and to compensate ourselves because of the size of the loan.
So when we say gross premium, basically we're saying it's like a commission that's being paid by the...
That's correct.
Like Wells Fargo pays a commission to WIMAC for originating the loan.
We as a broker get to shop for the best rate, and that changes all the time. We're currently active with 6 lenders who have good rates. We have a number of lenders who we've dealt with over the years who don't have good rates, and now we're working with them right now, or are out of the market. We've had a lot of lenders, MetLife comes to mind, that recently dropped out completely from doing mortgages. And a lot of other household names have disappeared. WAMU might be one you might remember.
Well, I don't know. I mean, B of A is a bit backed off.
We've seen the major lenders such as...
So what I'm talking about is in a wholesale, so...
And
so
in
people
retail
use-
as well. For
yeah,
example,
yeah.
and we can get into this, the HARP loans have become popular.
Okay.
And so B of A specific example, has really pulled back on even their retail efforts because they are inundated with HARP refinancing. Most of those loans right now, because of their enlightened self-interest, are their own clients from either Countrywide or B of A.
Yeah, they have a huge book from Countrywide that they're still cleaning up. So
They are still working those loans, and HARP is a one-time refinance which was loosened in the first quarter of this year so that clients could refinance if they were much further underwater than was previously allowed. Previously it was only mildly underwater, and now if someone's fairly dramatically underwater, they can go back to an existing lender, and in some cases, such as with us, they can, if they've got a Fannie Mae owned loan, they can refinance even if they're very dramatically underwater, which is a great thing. Now this is right now for primary residences only, but over time I think we're going to see it for second homes and eventually for investment properties. And that's a function of the lenders catching up with this backlog. The program runs until the end of 2013, so we have a ways to go on it.
Okay. We've been talking a little bit about the advantages of no points, no fees loans, and I was kind of surprised, actually. I was reading in the newspaper last weekend, somebody was writing in, like a letter to the editor type thing, or to a columnist really, for one of the real estate sections, and it was almost suspicious, like, my broker tells me this is, that he can do a no points, no fee loan. Is this really legitimate? Is this, so maybe you could explain a little bit why and how this works.
Okay, well, as I mentioned, the fixed costs of a loan are pretty much the same, and that's why we talked about the rates being higher for the smaller loans, because they have to cover the fixed costs. That's common sense. But unfortunately, there's still a lot of bait and switch in this industry. You will hear a lot of no fees loans on the radio. They're talked about all the time. Technically, a no fees loan, according to these lenders, means that there are no lender fees. You're still paying escrow and title, your appraisal, etc. You might even be paying a loan origination fee, but you're not paying a specific lender fee, which can be up to $1,000. So you are saving some money, but it's not a true no point, no fee loan, and therefore you have to amortize $2,000 perhaps in costs over the life of the loan, which may only be another 6 months if rates keep on going down dramatically.
So how can you tell? How can you tell that you're going to have these additional costs when the dust settles?
You need to ask for a good faith estimate. That's one of the couple of documents that count in terms of disclosures, and people who can give out a false good faith estimate can pay consequences for that. So the people who are required to put out a good faith estimate generally will give you an accurate idea of what your closing costs will be, and therefore you can make a more reasoned decision, and you can do some shopping. If you just go to the internet and try to do it that way, you're going to be very disappointed, because the internet still is not what I would call a safe place to shop for rates. It is still full of bait and switch.
Okay. I'm just thinking that, it seems like there's a lot of players that have been coming in, I guess, like Intuit, I guess, has even been involved in promoting some sort of a mortgage program.
Quicken is the old, what you're probably thinking of, and that's actually a company that's spun off of Intuit. It's no longer involved. It's a Midwestern company now, and they are one of the top 10 lenders in the country. And they're very competitive, as are people like Provident, which is locally based and is one of the top 10 wholesale lenders also in the country. And each one has their own niche. And you'll find that people like Provident, for example, will not refinance a condo. They have gotten completely out of doing condos. And so you can have some lenders that are very selective and have certain niches, which has been common over the years. Lenders tend to find a niche and somewhat specialize in it, but we still have a lot of fairly vanilla apply to 80 or 95% of the qualifying borrowers, lenders, who have pretty much similar rates. What is different is how quickly can they close a loan and how well they can close a loan. And we find, because of personnel shifts, because of policy shifts, because executive emphasis changes, that shifts fairly often. And so we find that different lenders do different loans well over time. And that's why having a mortgage broker who's conscientious is a good idea.
Okay. All right, Peter, we only have a couple of minutes left, so I think I'm just going to let you throw out, maybe a key idea that you want to emphasize for our viewers today.
Well, I think the key thing to understand is until, in this case, the big problem at hand, the other elephant in the room, which is Europe, until that situation gets resolved, which may take many years, rates are likely to come down because money will flow in not only from Europe but from all over the world into the U.S., which is still, even though we have our own difficulties, considered a pretty safe place for money, and that is driving down all rates, but particularly mortgage rates. And even though our costs, and government has added some costs to our process, our costs are a little bit higher than they were in the old days, but it still becomes very attractive as treasuries come down, the correlative rates go down.
So I think I'll sort of throw in a side note related to this, and that is the signpost is when the stock market is doing terrible, that's probably a good time to call your broker and find out what's going on with interest rates, because there's a good chance that there may be a little dip at that time. And
yes, there is a rough correlation over the longer term, short term not necessarily, between stock prices and mortgage rates. And money flees the stock market, has to go somewhere, and a lot of it flows into mortgage instruments, driving down rates.
Okay, folks, I think we've given you some valuable information today, something to think about. It's really the tip of the iceberg. We only have our few minutes for our interview. But you have contact information for Peter. We have CPAs that are helping out clients and so forth. You may talk to them. And anyway, we'll see you next time on Financial Insider Weekly.